Floating rate loans became increasingly popular over the last few years as interest rates dropped to record low levels, and many investors believed that rates would stay low indefinitely. But fast forward to today, and properties encumbered with floating rate debt have become some of the most at-risk deals in the entire commercial real estate market, with the 30-day average SOFR rate, or the interest rate index used to benchmark many floating rate loans, jumping from less than 10 basis points back in March of this year to almost 300 basis points less than 9 months later. And at a time when distress has yet to hit the commercial real estate market in any meaningful way, if you're trying to figure out where opportunities might come up in the future as a result of all the changes we're seeing in interest rates right now, in this video, let's walk through how floating rate loans are impacting investors today, what might happen if rates continue to rise or even stay at current levels, and how this all might ultimately create a significant amount of buying opportunities for commercial real estate investors in 2023. So to start this video out, let's take a step back and first talk about what a floating interest rate actually is. In a floating rate loan structure, instead of the interest rate staying the same or fixed throughout the entire loan term, a floating rate loan calls for the interest rate to be adjusted on a regular, consistent basis based on changes during the loan term to the base index rate. And for commercial real estate loans in the US, this index is generally going to be the 30-day average SOFR, or secured overnight financing rate, and interest rate and related payment adjustments are often going to be made monthly to reflect changes in this index over time. Investors often choose to go this route due to the fact that the initial rate on a floating rate structure is generally going to be lower than comparable fixed rate loans, and if the investor believes that rates will stay the same or even decrease during the loan term, these can often be very preferable options to fixed rate product. And to make these structures even more compelling, investors that use floating rate loans also generally purchase what's referred to as an interest rate cap, which essentially provides insurance that the floating rate on the loan won't exceed a certain predetermined figure for a set period of time. But with interest rates rising so quickly in 2022, the cost of these rate caps has increased substantially over the last 9 months, with many borrowers and mortgage brokers reporting cap costs today of anywhere from about 3 to 10 times what the borrower would have paid for the same cap in 2021. And even though these caps can be helpful to protect against rising rates, not all borrowers that use floating rate loan structures end up buying a rate cap in the first place, and even for investors that do choose to hedge their bets, most rate caps will actually expire within about a 2 to 5 year time frame. This has all led to what I see as one of the biggest potential sources of distress in the commercial real estate market, especially on deals that were acquired in the last 18 to 24 months at going in cap rates between 3 and 4%. And to show how this might all play out in the very near future, let's take a look at a sample deal that was acquired back in May of this year that's running into this exact problem with operations today. This property was purchased for $10 million at a 4.2% going in cap rate and a floating rate loan covering 65% of the purchase price. This loan was priced at 385 basis points above the 30-day average SOFR rate, and a 2-year rate cap was also purchased that limited the variable component of the loan to no more than 300 basis points, resulting in an interest rate ceiling of 6.85%, with interest-only payments owed for the entire 5-year term. Now, back in May, the 30-day average SOFR rate was sitting at right around 50 basis points, so the all-in rate when the property was acquired was just 4.35%. And with the property generating $420,000 in annual NOI and paying out roughly $280,000 in annual debt service, a 4% cash-on-cash return is nothing to write home about, but this is also not a huge cause for immediate concern. But fast forward to today, and that 30-day average SOFR rate has now jumped to 2.97% as of October 20th, putting the all-in rate on the deal just 6 months later almost right at that cap at 6.82%. And even if the property owner was able to increase NOI by 5% over this 6-month period, which would be a significant jump given the increases in operating costs related to high single-digit inflation that many investors have had to take on this year, that annual NOI would now sit at $441,000, but annual debt service would have risen to $443,000, putting the investor in a negative cash flow position. And even if this investor believed that interest rates would continue to rise in the future and wanted to refinance into a fixed rate loan product today before this rate cap expires, this would not be an easy process. It would almost definitely require an additional equity investment in order to make this happen. Most commercial real estate lenders will size fixed rate loans based on a minimum debt service coverage ratio or DSCR value, meaning they'll back solve to a loan amount that results in annual loan payments that can be covered by the in-place NOI, usually by a margin of at least 1.2 times. And even if we assume a lower 6% interest rate on a fixed rate loan with a 30-year amortization period and a 1.2x DSCR constraint, with that same $441,000 NOI, the maximum loan proceeds that a lender would be willing to issue would be just $5.1 million or $1.4 million short of the initial loan amount. This means that just to refinance, investors would need to come up with an additional equity investment that would make up over 40% of their initial capital contribution on the deal, which is not only going to result in a lot of angry investors, but sometimes is also not even possible based on investor liquidity. And if these investors can't refinance, can't service their debt without consistent capital calls, and an expiring rate cap would cause debt service payments to go even higher in the future, this is very likely going to lead to investors being willing to sell properties at a significant discount to what they bought them for, or even having to hand the keys back to the lender if loan covenants are breached. Now, I'm personally heavily invested in real estate, including some deals with a floating rate loan structure, so obviously I'm not rooting for a sky-high interest rate scenario, but in a market where it's been so difficult to find value since really the beginning of 2020, this cycle playing out on a large scale could result in a significant amount of distress in the market and buying opportunities like we haven't seen since the early 2010s. I have no idea how high rates are going to go, but regardless of where you think rates are headed in the future, the reality of this is that the commercial real estate financing landscape is significantly different today than it was just 1 year ago, and unless rates come back down substantially in the next 6 to 12 months, I see a huge amount of opportunity related to these changes. And if you want to make sure you're ready to capitalize on these opportunities when they do come up, and you want to make sure that you can run your own investment analysis to find value in the market, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the state of the commercial real estate industry, make sure to hit the like button and let me know. And let me know in the comments where you think we'll start to see distress in the market and when that distress will show up. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.